As a Canadian working abroad, it is essential to understand the tax implications of earning income in another country. Although the idea of living and working in a foreign country can be exciting, the thought of navigating through tax laws may seem daunting. This guide will provide a general understanding of key tax considerations for Canadians working abroad, ensuring that you stay compliant with required laws and regulations while maximizing potential tax savings. Before discussing specific tax considerations for Canadians earning income abroad, it is crucial to determine your tax residency status. Your tax residency status, whether as a factual resident, deemed resident or non-resident, will significantly impact your tax liability in Canada. Generally, tax residency is based on factors such as lingering residential ties with Canada, duration of stay abroad, and intentions upon leaving. A factual resident is an individual who has left Canada temporarily and is still considered a resident for tax purposes. A deemed resident is an individual who has severed residential ties with Canada but is still considered a tax resident due to specific conditions, such as residing abroad for less than 183 days in a calendar year. A non-resident is an individual who has severed residential ties with Canada entirely and is no longer considered a tax resident. Your tax liability in Canada is dependent on your tax residency status. Factual and deemed residents are subject to Canadian income tax on their worldwide income, regardless of where it is earned. However, non-residents are only subject to Canadian income tax on income earned from Canadian sources. In some cases, individuals may be required to pay foreign income tax on their income earned abroad. To avoid double taxation, Canada typically provides tax credits for foreign income tax paid, depending on individual circumstances and the existence of tax treaties between countries. As a Canadian working abroad, you must report your foreign income and assets to the Canada Revenue Agency, CRA. A factual or deemed resident is required to report their worldwide income using a T1 income tax and benefit return. If you are non-resident, you must report income from Canadian sources using a T1NR tax return. Additionally, you may be required to report foreign assets with a value exceeding CAD $100,000 on a T1135 foreign income verification statement. Failure to report foreign income and assets adequately can result in substantial penalties and fines. Canada has established tax treaties with numerous countries to prevent double taxation for individuals earning income abroad. These treaties typically provide reduced withholding tax rates on items such as interest, dividends, and royalties. Furthermore, tax credits may be available for foreign taxes paid, ensuring that you are not taxed twice on the same income. Totalization agreements, also known as Social Security agreements, are designed to coordinate pension and benefit programs between countries. These agreements can help Canadians working abroad maintain eligibility for Canadian pension benefits, such as the Canada Pension Plan, CPP, and Old Age Security, OAS, while also avoiding double contributions to foreign pension plans. As a Canadian working abroad, it is crucial to implement tax planning strategies to minimize your overall tax liability. Some common strategies include understanding and utilizing tax deductions and credits available to you, both in Canada and abroad. Maximizing contributions to registered retirement savings plans, RRSPs, which can help reduce taxable income and defer taxation until withdrawal. Considering tax implications when choosing between employment income and self-employment income abroad. Seeking professional tax advice to optimize your unique financial situation and navigate the complexities of your Canadian and foreign income tax obligations. By better understanding the tax considerations related to working abroad, Canadians can ensure they minimize tax liabilities and avoid unpleasant surprises come tax time. As always, it is essential to seek professional tax advice tailored to your individual circumstances and financial goals.